Now, as we get going here, I need to make everyone aware, again, for disclosure and disclaimer purposes, trading foreign exchange on a margin carries a high level of risk and is not suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your monetary objectives, level of experience, and risk appetite. There is the possibility you can sustain a loss of some or all of your deposited funds, and therefore you should not speculate with capital you cannot afford to lose. You should be aware of all the risk associated with foreign exchange trading and seek advice from an independent advisor if you have any doubts. Past returns are not indicative of future results. Your trading results may vary, and in tonight's presentation, there's no representation being made that any software or training or indicator, for that matter, will guarantee profits or not result in losses from trading. So now that we got all the legal stuff out of the way, let's get into it. The Traders Dynamic Index, all in all, is a all-in-one indicator. When I was designing it back a few years ago, my attempt was I didn't want so many indicators on the chart. If you're similar to, well, let me just back up just a sec. If you're like me, a few years ago, I thought I needed this indicator and that indicator and this indicator and that indicator, and I had so many indicators on my chart that I literally couldn't see price. And on top of that, I had so many indicators stacked down below the price chart area, I couldn't necessarily make out those indicators as well. And someone had recommended to me, said, Dean, find those things that resonate with you in the market and put them all together. And what I noticed was that there were three common things that I was looking for in relationship to price, and that was trend direction, momentum, and market volatility. As Steve commented in his training, this system of his is a trend system with momentum, and it's interesting how the Traders Dynamic Index, taking the trend direction, taking momentum, and taking market volatility all in one, helps us determine what the market most likely will do following the market maker method and following the overall market structure, as I like to refer to it. So let's break it down a little bit more in detail. The Traders Dynamic Index, the original design of it, incorporated 5 lines. You have a green line represented by an RSI. The RSI is a modulated RSI which follows price. It's very similar to price action, but I don't want it to replicate price. I want it to share with basically market sentiment, the strength or weakness in the market related to price. I didn't want a copycat line. I can see what price is doing. I wanted to know, and I refer to it as market sentiment, the strength or weakness in the market following what price is doing. That's represented by the green line. The red line is what I refer to as the trade signal line. And if you're following along with me here in the chart, to make it a little bit easier for you, this is where I am right now. If you see the bouncing red ball there in the lower left-hand side, so the red line is where I'm at right now. That's a trade signal line. Many of us who were introduced to the Forex market were familiar with the software package that came out a few years ago, and it used green and red line crossovers. Crossovers is something that's very synonymous with traders. It's very easy for many of us to see moving average crossovers. So the red line is a moving average of the green line to a certain degree, and it's using that moving average crossover to help you determine a potential entry or exit. So when the green line is above the red line, like right here, a potential buy. When the green line crosses over and starts dropping below the red line, a potential sell in that situation right there. Now the yellow line, what I wanted was something that really showed the overall market. We all know that current price, the speculator movement in the marketplace, moves much faster and quicker than the overall market. The overall market has a tendency to turn slowly. But when you are monitoring the overall market, which the yellow line, or some of you all refer to as the gold line, when that turns in a certain direction, you have a lot of the market behind that move. There are times where the current market, or the current price is going to bounce back towards the market, but you can see starting out here, we have an overall trend of the market to the downside. Current price may try to come up against the overall market, but if there's strength in the overall market, it will then turn current price back in the direction of the overall market. One of the things I advise folks when they're using my model, the synergy model, is when you look to enter into a trade, you want to see that the green line and the red line are working with the yellow line, and the yellow line should be more or less flat. So let me back up just a sec. Speaking of the yellow line, I look for the yellow line to go flat or trending in a direction. And we're going to look at a few examples where that's not necessarily the case this evening. But oftentimes right here gets folks in trouble when that green line is going up and the yellow line is going down. I refer to that as X does not mark the spot, because that forms an X, does not mark the spot to get in. Now, some will contest with me on that now that they know Steve's market structure. So we're going to take a look at that a little bit more in detail. Okay. Now the blue lines. The blue lines represent the volatility of the marketplace, and one of the things I'm looking for is when the volatility opens up and when the volatility squeezes down. And this is an example right here where I refer to it as it's squeezing together, coming together. I get that from John Bollinger in his book Bollinger on Bollinger. He talks about the squeeze. When everything's compressed, we expect the market to pop or to break out of that compression. And at times, we'll see when the volatility bands start coming closer and closer together, expect the market to break out in a certain direction. In this case, we break to the upside, and you have the green line above the yellow line. And we're going to talk a little bit about the shark fin and some of the other terminology that Steve uses. Okay. Now, I also have 3 lines here that are dash lines that go across the TDI. The 68, the 50, and the 32. And we'll talk about more of those in detail. Steve has actually added a couple more lines to the range here. So let's go through this a little bit more in detail. First thing I want to do is start out with the green line, because that is a very important line. The green line, also referred to as the price line, basically what you're looking for, and they make it very simple. And now this is a little bit more conservative and not necessarily along the lines of what Steve's doing with his market structure, but as I teach it, I tell folks to look for a long potential when the green line starts breaking above the 50. Look for a short potential when the green line starts breaking below the 50. The reason for that is you have buying sentiment up above the 50. This is where buyers are buying. And you have selling sentiment in the marketplace when the green line's below the 50, and this is where sellers are selling. Now, obviously, there's going to come to a point where the market's going to go too far beyond. It's going to go up into an area of what I'm going to refer to as exhaustion area. We'll talk about that in a moment. Or it's going to come down, way down low. And you're going to get to a point to where it's gotten so low, no one wants to sell anymore. They're looking for the bottom dwellers are looking for a good buy way down low. And some folks are looking for a potential sell. When it gets up way high, no one wants to buy it anymore. And sometimes you get these sharp moves back in the other direction. But again, the principle here is look for the green line to go above the 50 for a potential long. Look for a potential short one. We're below the 50. Now, that may resonate with what you're doing with Steve's method. It may not. Some of you may just be looking for the shark fins, as he refers to them in his training. Let's go to the next page here and take a look. Now, as I was talking about, the 50 line is pretty critical. Just like the 50 line, I mean, just like the normal RSI, the 50 line represents sentiment in the marketplace. And as I mentioned earlier, when we are above 50, you have buyers buying. When we're below 50, you have sellers selling. Oftentimes what gets folks into trouble is they see the green line coming down right here. And make note of this. If you're following along with me, I suggest taking some notes. So what sometimes gets folks in trouble is they will see the green line going down. But this green line going down is not below the 50, so they're looking, well, here's a sell right here. However, look what the market does. The market abruptly turns back up, and those who were selling right here now are worrying about, should I stay in this trade, or should I get out? What should I do? Oftentimes, a more conservative move would just be to wait for the green line to cross the 50. Okay? Now, of note, just because we crossed the 50 one way or the other, look in this example right here, it crosses the 50, so you're looking, well, I'll just buy right now. Well, there may be some other aspects of the marketplace to consider. Maybe there is divergence in the marketplace. Maybe there's some economic event that's going to drive the market back to the downside. Maybe the overall market is still trending to the downside, and this is just coming back towards the market baseline, the yellow line, which we don't see here. We'll see that in a moment. But just because you cross the 50 line doesn't necessarily mean it's a go. There's no guarantees in trading, as we all know. So just be aware that you're considering what the overall market is doing and what economic events may be taking place in the marketplace before you step in just because you're crossing the 50 one way or the other. Now, as I mentioned earlier, I refer to going above the 68 as buying exhaustion. And let me phrase that a different way. For any of you who jog or long-distance runners, you're running up a hill. Well, at some point as you run up that hill, you're going to gain fatigue. It's just going to happen. And you're going to come to a point where you just can't go anymore, and you're going to take a rest. After that rest, you may run higher. Well, the trade's going to do that to some extent. The trade's going to come up, it's going to take a rest, it's going to come up. It may actually have to come down a little bit before running back up. But typically I find that when you get above the 68 on these shorter time intervals, 5, 15, 30, there's oftentimes you will get V-shaped formations in the green line. The green line will actually come up and then start coming back down in a V-shaped formation, giving us those shark fins that we look for, as Steve refers to them. So look for when we go above the 68, if you're down to 5, 15, 30, look for that eventual turn. Now, folks have often asked me, well, Dean, but the green line keeps going up higher and higher and higher on an hourly chart or on a 4-hour chart. It just keeps going higher and higher and higher. And yes, it can, because this can run all the way up on a 1 hour or 4 hour. It can go all the way up to the 90 area. I've seen it go that high before on those charts. But the smaller time interval charts have a tendency to fluctuate much quicker than the longer term. So when you're on these shorter term charts, again the 5, the 15, maybe even the 30-minute, you can see an immediate turn. And that's why Steve likes to use the 15-minute chart to some degree, because the shark fins are very much apparent when you get above the 68. Okay? Let's continue here. So again, buying momentum will slow and reverse when you're above the 68. Selling momentum will slow and potentially reverse when you're getting less than the 32. Just this past week, I saw on some of the pairs the green line drop all the way down to like a 6 or 7. So it can drop, and it actually went below the 32, came back up a little bit, and then dropped further down on some pairs that I was monitoring it during my trading room. Now here's an example of what I'm talking about here, comparing just the green line, which is the RSI price line, comparing that with price action. Okay, you can see at times the green line, we were talking about potential buying right here, but it's not necessarily set up just right here. And what I want to avoid happening is this type of situation where we're down low and say, well, it's not going to go any lower, it's starting to turn up, let's buy. Well, but we get into this period of consolidation. It could be accumulation. But we get into this period of consolidation with no real clear picture. Where here you can see that the green line dropped down below the 32, started working its way up. And notice that once we got above the 50, now this is my model that I use, the Synergy model. Now I have my average price bars making a nice move to the upside, and I have price action and what I refer to as market sentiment saying the same thing. They're both sharing the same story here, okay? Market comes down a little bit, pushes back up. Notice how we did not break the 50 line here. So the market just came back, and if I take maybe a fib retracement here, that's maybe a 23.6, maybe some profit taking going on, and then the market pushes back up higher. And for those of us who follow what Steve's talking about, maybe this is a 1, a 2, a 3. And then we get that slight, look at this, very slight, you see this right here? Very slight M pattern, and then bam, what we are all looking for, that right there. And notice right here, it goes up, comes down, back up a little bit, a lower high, and down. Nice setup right there. Okay? Now, let's compare Steve's TDI with the original one that I did. Now, Steve includes 2 additional lines. You can see that over here I have the 68 and I've got the 32. Steve includes the 63 and he includes the 37. So we have literally a range up here that we're looking for the market to turn and reverse on the 15-minute. And here we're looking for a potential reversal to move to the upside. Here's a nice little shark fin we talked about here, but the market's not done yet, and the market pushes back down. Safer bet to buy when you start getting down into this range down here. Okay, let's take a look at the RSI price line, just of Steve's RSI price line. Now, he uses an RSI 21 in his tool, and again, his range is a 63 to 68. So what we're looking for as we get into the 63, 68, I refer to that, maybe he refers to as well, the selling range. We're looking for the market to turn, give us that look that's going to turn over. Notice here, now I don't have price showing right now, but notice here, do you see an M pattern right there? Do you see the up, the back down, the up, and then the down again? The beautiful thing about the TDI is oftentimes I will see the M patterns and the W patterns, the head and shoulders or the inverse head and shoulders within the TDI. Okay? So here is a double bottom, but it's inclining double bottom. We get a nice little push up. Okay? Now, the 32 to the 37, this buying range right down here. So again, you're going to look to trade short when the RSI price line is greater than 63 to 68. If it follows the market structure we're looking for, you're going to look, in Steve's method, you're going to look to trade long when the RSI price line, along with other aspects of the market, and what you see in the charts, is less than 32 and 37 in that area. Okay? So let's compare, like I did a moment ago, with my original TDI with his TDI, his setup, compared to price action. So we can see here, let's just go from left to right here. You can see the green line coming down, making a low point right in that range, comes back up to a midpoint. Look what price is doing. Comes down to this low point here, comes up to a midpoint and back down. I would have to say we have a W pattern right there, a low, a midpoint high, another low, and notice how this low does not take out the previous low. And look at your RSI price line. See, it is higher than the other one. So as this turns up, this is going to turn. You break this high point here. This is breaking this point here. Now, Steve will actually suggest to step in earlier in this area right here. Now, what you see here is my synergy setup, not Steve's chart setup, but this is my setup. Okay? But just taking my setup that I use, you could enter in a long right in this area as we're breaking out right in this area. And makes a nice little push all the way up. And here, once we get above the 50 line, it takes a little bit of a rest, but there's no indication to exit the market, and it makes another strong push to the upside. Okay, let's talk about the M shape, or the M formation, or the M pattern we were just talking about a moment ago. Market comes down right here to that high, comes down a little bit, comes up. Now, using the average price bars here, we're still pushing up. We haven't yet come off of it. So this doesn't set up as a M formation or M pattern that Steve would be looking for. Okay? But here, looking at price, it comes down, back up, and you notice how this is actually below the sell range from this high point to a midpoint, back up. And now, as this settles right here, about that low point back here, it settles there, and then the market just drops right off. A nice trade to the downside right here, and it follows. And by the way, take a look at this. We come down, 1, 2, 3. 3 level drop right there. 1, flat, 2, flat. If you sold up in this area, okay, if you sold up in here, it comes down. Not much of a move, but we do see a drop, flat, drop. Sometimes it'll kick back a little bit, especially when you're not, if you can't tell if there's consolidation going or not. Look for the green line to start pulling back the other direction. That'll let you know that there's consolidation going on. So there's our next flat, and then the next drop down. So 1, 2, 3 down like that. We get a very much a low right here, down below the 32. It pushes back up. So here we're going into that consolidation phase. We get a W formation, and then the return to center. Or the return to, we get a low, a W formation low, and then return to a consolidation or a range in this area. But you can see it right here, low, up to midpoint, back down, a higher low right there, a higher low in price, seen in price, and then continual move up. Okay? So there's a lot there in that green price line right there, but one of the key things I want to point out to you as you trade it is if you're not sure if you're getting consolidation or not sure about that, then look at your green price line. If the green price line is turning back, and you can see how it rises up right here, if it's turning back against you, then there's a period of consolidation setting up for the next push down. There's the 1, 2, 3, or level 3, 1, 2, 3 down that he looks for. Okay, let's go to the next slide here. We have the trade signal line. Again, I was using the trade signal line as an indication of potentially entering the market on a crossover. Okay, so trade long when the green is over the red, or trade short when the green is below the red. Okay, now there's less risk, and I need to point this out because I'll get folks who will literally sell way below the 32, but you have less risk in a trade when the green and red are both greater or less than the 50. They're within this range right here. You don't want to be buying when you're above the 68. You don't want to be selling when you're below the 32 unless you're just crossing over the 32. What I mean by that, let me clarify, you don't want to be selling when the green line is down here like at 10 or 12, 15, 6. The market could push on down, but just be aware that oftentimes those are institutions pushing the market even further. Okay, there may even be those market makers out there just getting those last bit of stops, and they're pushing it lower and lower and lower. But don't be selling way down low, or avoid selling way down low. Avoid buying way up high. Okay, be prepared for the turn in the market. Now, then here we have the market baseline. Now, as I mentioned, the market baseline is the overall trend, or is the overall market. Okay. Now, like the RSI 50 line, the market baseline is a moving or liquid 50 line. It moves with you, so you don't necessarily have to wait for the green line to break this 50 up here because it's breaking the liquid or moving 50 line, the market baseline right here. So you could literally enter your long right in that spot right there. You could enter your short. Even though we're not below the 50 line, the 50 dash line, we're going below right here. We're going below the yellow market baseline. Again, we are breaking the overall direction. And notice also that in this case right here, the market's starting to flatten out. Not necessarily flattening out here, but when the market starts to flatten down as you break it with the green line, that's a pretty good potential entry for the trade right there. Okay. Now then, let's take another look. So trade long when the green line's below the, greater than the yellow. Trade short when the green line is less than the yellow. And I'm giving you conservative estimates here in your trade. If you want to trade it when it, I've got people who'll buy right here, but like right here is coming down low to a low point, and they'll buy right there, and they wish they had when it gets back over here. Either that, they'll hang in, or they'll have to work themselves out of the trade. So Here's the market baseline compared to price. You can see that the overall market is moving down. Market moves down. The market kind of flattens out, starts to turn. It eventually turns, and then the market baseline turns with it. Market starts to come to a high point, starts to eventually turn. We flatten out, and we finally turn because the average of price here compared to the average of price back here, we kind of just go flat here. Again, the market overall, the overall market moves much slower than the current market that we're seeing with our price bars and the green and red line. Now, one unique aspect about the market baseline, and make note of this, is when the yellow line, the market baseline itself, gets up to 68 or gets down to 32. When I was originally designing it years ago, this was something that just by happenstance, I noticed. I was like, wow. When the market baseline reaches a 68 or reaches a 32, typically I'm at a point of potential market reversal. And I didn't try to design it that way. It just worked out that way. But you'll notice how the market baseline comes up to the 68 here, price comes back, but it may not be done just yet. So be aware of what price action is doing. Here we have a nice M formation, a W inside the M, but an overall M formation. The market finally turns. Here we come up to a high point right there. Market sentiment, or the overall trend of the market, starting to turn lower, but price wants to make one more turn. We'll talk about that here in a moment, where price doesn't necessarily follow through. Here we come down to a low point. Market works off of that. Back up to a high point. Market works down off of that. So something to look for. Again, make note when that market baseline, the yellow line, gets to the 68 or gets to the 32, start looking for a turn in the opposite direction. Potential market reversal there. Now we have our volatility bands. One of the questions I've often received from folks and continue to get are, these Bollinger Bands, they're not exactly Bollinger Bands. They are a standard deviation band, similar in the mathematics, but not exactly the same components. But there's some similarities here. So in this case, we're still looking for the bands to expand or contract or squeeze down. And when we get that squeeze or that compression, we're looking for the market to potentially break out. One of the unique things I found in trading the TDI is when the green line breaks above the blue volatility band, you can literally add to a position. And I know that's something that Steve does in his own trading, is adding to a trade when we break the blue volatility band. And I forgot to mention, he also adds to his position when the green line breaks the market baseline as well. So scaling in his technique of scaling in, he looks for a break of the market baseline, but he also looks for a break of the blue volatility band. Now, one of the things I often share with folks is what I refer to as the hidden secret of the Traders Dynamic Index. And that typically is when the green line breaks the blue band and we're between 50 and 68 for a long. That typically indicates a good potential trade to the upside. The market has squeezed down in such a way that the move up is highly viable. There's a high probability that we will move on up. Now, in this case, the market pushed down, then made its final move up. Okay? Same thing holds true in the reverse. If the green line breaks the low blue volatility band, and in this case right here it did not, but let's say, for instance, that this blue volatility band squeezed up a bit higher, and the green line came through, and we're between the 50 and the 32, typically that's going to indicate a potential strong trade to the downside. There's so much more movement or momentum to the downside still available because we're between that 50 and 32. Okay? So let me repeat. When the green line breaks the blue volatility band, and both the green line and the blue line are between 50 and 68, there's a high probable trade long in that situation. When the green line breaks the blue volatility band and they're both between 50 and 32, there's a pretty strong probability that we're going to have a good short trade to the downside because there's such a distance for the market to get back down to 32. Oftentimes I've noticed how the market will get what I refer to as off-center. When the blue bands tighten down and they all shift one side or the other. I've got some slides to show you. But when the blue bands literally shift from one side to the other, the 50 line, look for a good reversal in the opposite direction. Let's go through this and I'll show you what I mean. Well, before I get to that, let me talk about the tightening of the bands. One of the things to look for, that squeeze or that compression of the bands, you can see that we've been in a tight price range right here, and you can see that the bands themselves are kind of tightening down a bit. Expect a breakout, and here the market does break out. And this is what I was talking about, that hidden secret of the Traders Dynamic Index. The green line is breaking below the blue volatility band. This crossover is in between 50 and 32. We expect a nice push to the downside. That's what took place. Let's look at it on Steve's setup here using Steve's TDI. Okay, you can see here how price is kind of range bound in this area, but notice how the blue band, and I've colored it a little bit darker so you can see it better here. Notice how it's tightening down. It just keeps tightening down, tightening down, tightening down. When they all compress, they squeeze down, expect a nice pop, okay, or a nice breakout. And here we get a breakout right here and a nice push to the upside, okay. Now, in this case, we get the shark fin, but what I look for is the fact that I want to see some red bars start to turn and go back the other way, and we don't. They actually come back to what I refer to as my price action channel, and it stays on top of the price action channel and makes another push to the upside. So this could be a 1 and then into the 2. I don't know if there's another level going up, but you can see a nice move on up. Okay, and you can see in this case, this is the 68 line. Here's the 32 line. This squeeze, this compression that we had caused such a strong breakout that the green line literally went so high above the 68. And that can happen from time to time. Okay? So what you want to do is you want to treat that TDI as your trading buddy to inform and confirm price action. That's the way I originally designed it. I basically refer to TDI as market sentiment, the strength or weakness in the marketplace. I see trend direction, I see momentum, I see market volatility. What I mean by market volatility, and some people send me emails, so let me answer that. Notice here that when we get the breakout, if I were to draw a clock face right there, if I was just put a clock face right here, okay? Let me see if I can do that here. Let me see if I can do that. Something to that. Okay, you see that? Notice right here, what direction is that green line going? If this was a clock face here, would you say that that green line is going up towards 1 o'clock? That's what I would think. When you have that green line going up to 1 o'clock between 12 and 1, you have very strong volatility in the marketplace. When you have the green line going between 1 and 2, standard volatility, decent trend typically. When you have the green line going between 2 and 3, very little volatility, very little momentum in the marketplace. Now on the flip side, when I have that green line going down between 5 and 6, you have very strong momentum and volatility in the marketplace. And probably a very good short potential. Again, if that green line is going down between 6 and 5 o'clock, very strong potential to the downside. Should have some good momentum and good volatility. If it's going down between 5 and 4, between 4 and 5, that's a standard angle to the downside. Okay, so we should get standard momentum, standard volatility in the marketplace. If the green line, though, is starting to come down, it's basically in between 3 and 4, there's just not much momentum, not much volatility, I just stay out of it altogether. Okay? So typically to enter a trade, I'm looking for a good, strong angle on the green line. I'd like to see that green line go between 12 and 2 for a long, or I'd like to see the green line go between 4 and 6 for a short. Okay? So hopefully you understand my little analogy of using a clock face right there. Okay? So I look for that. Whoops. Let me get rid of this guy if I can. Let me see here. Okay. There we go. Okay, so you use the TDI to help confirm entry and exit conditions. We can also look to determine positive and negative sentiment. And one of the things that I like about the TDI is it also helps me identify bullish and bearish divergence. So let's take an example of some divergence in the marketplace. In this case right here, the market's come down to a low point here. I'm looking at my TDI. I'm down below over here. And we come down to a low point. We come up a little bit, back down, and then we push off. So we literally have a W pattern, slight, but there is a W pattern or formation in the TDI. Price doesn't show it very clearly here, okay? But look what happens. We have lower lows in price, higher lows in our green line. That's bullish divergence. We expect the market to turn. And so literally using Steve's method here, we're going to be looking to get into that trade somewhere in this area right here. As it pushes off of that low point right here, and we have divergence. I think there were some comments in the Orlando training of one person who does this every day in the U.S. session, just trading out of the red box looking for divergence, one of her aspects. And she talked about looking at the TDI and looking for divergence of the TDI compared to price action. So you want to use that green line to determine that. So use the green line of the TDI as a market sentiment compared to price activity when considering bullish divergence. So we have it right there, bullish divergence. Very easy if you're not familiar with divergence. Very simple. What you're looking for, lower lows in price, higher lows in the green line, or higher valleys. This is a higher valley or dip than this one over here. And this is probably not the best indication, but that's an indication of bullish divergence. Now, bearish divergence. Bearish divergence basically is where we have higher highs in price. So you have this high point. It goes into a period of accumulation, consolidation, but then we pop out. You remember Steve talking about the Asian box, and here we are coming from, here's on this chart right here, this is the start of a new day. We kind of go flat, market pops out, but look what's going on right here in our TDI. See, I have this high point here, and I have a lower high over here. So the expectancy here is for the market to turn and go down. And we'll just wait for that setup. We're prepared to see if we're going to break through the other side. Now, do we get a little, we might get a little bounce up, give us a slight information in the downward move. We might just come straight on through the range here, this consolidation or accumulation range right here, and break straight through. But that is a good sign of bearish divergence. Again, if you're not familiar with divergence or bearish divergence, higher highs in price, lower highs in the green line. Now, for those of y'all who've written me and said, well, Dean, can I also see hidden divergence with the TDI? Yes, you can. You can see regular divergence, and you can also see hidden divergence. And for those of y'all who's like, well, I can barely ever see hidden divergence, it's because it's hidden. That's how it gets its name, hidden divergence, because it's tough to see. But there's a comment here I want to make. Regular divergence is an indication, not a signal, but an indication that the market should reverse. Hidden divergence, on the flip side, hidden divergence is an indication for the market to continue in its direction. Not a signal that it's going to continue, but an indication of continuance in the market. Okay? So let's go take a look at some notes here that I wanted to make, some comparison of the original TDI that I designed along with Steve, and a couple other notes I wanted to share with y'all, and we'll wrap it up. So I've had a number of folks write me over the last 2 or 3 weeks saying, hey, what's the big difference between your TDI and the one that Steve uses? Well, if I can sum it all up, it really comes down to what I use as the RSI setting compared to what Steve is using. Everything else is pretty much the same. I use an RSI 10. I originally designed it with an RSI 13, but as an active trader and the way the market, the high amount of volatility that the market has seen, we're getting more and more volatility, a lot more whipsawing going on in the marketplace. I literally tightened it from a 13 down to a 10. Now, I want to share with you, because what we're going to do is we're going to kind of go back and forth with this slide and the next slide. You can see some comparisons, but you'll also see some differences. You can see how the market tied down. This is actually a trade that I announced in my room the other day, and for those of you all trading Steve's method, it was a beautiful setup. We literally come out of a period of accumulation here. The market does a head, well, it moves one way, not necessarily the head fake, but the market makers pushing it one way. It turns, we get our first leg up in the M formation, comes back to the midpoint, another push up, cannot take out the higher highs right here, turns over a nice M pattern right here, and a nice push down, okay? In this case, the market goes to a low point, get that shark fin. Now notice here also, 1, 2, 3. You see the flat? You see the flat right there happening? Okay. We even had a slight flat right there if you don't want to consider that original one, but that's 1, 2, 3 down. And then we get, you know, the turn right here, blood in the water, as Steve refers to it, and we start getting that push back up. Okay. And then it comes here right to the market baseline, bounces around it, adds that position, pushes up, and then it goes back into that period. This is literally, folks, just almost exactly as Steve laid it out in the Orlando presentation, okay, in this flat spell. Now notice here how this kind of up and down right here. When I go to the next slide, you will notice with Steve's, this is Steve's, same price, same looking price here. Steve uses an RSI 21, and you can see right here it's a little bit flatter right in this area. And the shark fin may be a little bit more defined right here. We'll take a look. Let me go back. Here's my original. See how it comes down, flat, down again. Maybe not as clear a shark fin as what Steve has. Again, the original, and back to what Steve set up with the RSI 21. Okay? Notice how we're both tightening down over here. So market goes flat, volatility bands start tightening down, we expect a break. Okay? Same thing over here. Tightening down, we expect a break. We expect the next setup. Let's go to the next slide. Now, something I shared with everyone in Orlando was look for the lines to compress high, low, and sometimes in the center. So one thing to look for is when all the lines compress, and this is, I was trying to find one where they were compressed and way up high, but when they get compressed and they get up around the 63, 68 area or higher, just be ready for the fall. It will happen, okay? Now, notice here too, I want to share with you something here. Imagine, if you will, you just see the green line. You see that green line right there? What pattern is that green line forming right there? We have a high, a higher high, and a lower high. How it kicked back a little bit right there? There is a head and shoulder pattern right there. We're squeezed and we're up high. That's all an indication to go down, and this starts literally dropping, and price follows suit, and we get the drop down. We get a little pull back up, and another drop on down. Okay? So again, 1 flat, 2 a pull back, giving us consolidation right there. So 1, 2, 3. Just like Steve talked about it. Right there. So if you can't see it too clearly, this flat spell, when you see that happening in the TDI, that is an indication. Again, I'm using Steve's setup right here. So again, look when the lines are pressed high. Be prepared for it to fall. On the flip side, be prepared when they squeeze down real tight, get compressed. Imagine, if you will, I reach out and I grab the market with my hand and I make a fist. I'm squeezing down right there. Okay, so we get the squeeze right here, and then we get the breakout. And look at the angle of that green line. That green line's just about to 1230 there. A nice break right there to the upside. And everything's squeezed down. Look at price action. Comes down to a low point, comes up, to midpoint, back down, higher lows than this over here. There's your W formation, your squeeze. I mean, this is telling you, if you couldn't see past, if I were to draw a line right here and you couldn't see any of this over here to the right, I'd be telling you folks, this thing is ready to pop to the upside. It's so set up. And look what price is doing right here. Price is resting on top of, you see the W formation in the TDI? Right there, W formation right off the market baseline. I mean, there's a lot of information for you right there. A W in the TDI, squeeze on the TDI, way down low, W formation and price. I don't know how much clearer I could tell you that that's a long potential, except for seeing everything in history here, but that's a good setup right there. Now, one thing you're going to notice from time to time, though, is the market may have a tendency to squeeze right down around the 50 line. This would be Steve's 50 line coming across right here. Okay? Now, when it squeezes down and it's in the middle of the TDI, it can go either way. So what you're really looking for is what the overall market is doing. In this case, the market baseline, the yellow line, was way up high and it's coming down. Most likely, if all the economic factors are in place, I know that Steve's not a big proponent of the news, but I know from time to time there may be a news announcement that may cause the market to go one way or the other. There could have been something there that caused the market to push up. It could have been the market makers, as Steve addresses. So we could have gotten that push up, but look what the market ends up doing anyway. The market ended up following the market baseline on down, and look, there's the break. See how that's going down almost to 5 o'clock? The green line's going down to almost 5 o'clock. Breaks that blue volatility band right there. Again, I call that the hidden secret of the Traders Dynamic Index. Between 50 and 30, well, this would be Steve's 37, we should get a nice little move to the downside. Okay? And we do. I mean, there's a 1, flat, 2, little pullback, 3. 3's not much, but a little bit right there. Be careful, though. So when the line's pressed down in the center, it could go either way. Look at what the overall market's doing. And we can see an overall market trend line right here. Just see lower highs and coming across here, pretty well flat, not a whole lot. Lower highs, suggestion would be that the market would go down. Now let me share something that was, actually this took place for those of y'all who were in Orlando. This actually took place last week, or, well, we were there in Orlando. This is the 14th here, and we had just talked about the TDI. I'd gotten up on stage, mentioned a couple of things, and some folks started asking me, well, what do you think the TDI is? I mean, the TDI is showing the market coming back down. You can see how the market baseline went up way up high, coming back over the green line. Everything's falling back down. Shouldn't we see price fall back down? That's the expectation. So we have divergence set up here, but price isn't falling through. So what I'm getting at is we have a very nice move to the downside here in market sentiment, but price is pretty much staying flat in about a 40 pip range. This is where you have lack of follow through. And something I want to caution you by is this right here, and I told folks, and there were some folks from New York who asked me in the New York group, and I told a couple of them, I said, listen, if this does not follow through, this is a setup for a pop-up. And that's what happened. When the market comes back, when the market settles back down, and it's coming right back down to 50 line right here, when the TDI comes back to center, okay, when it comes back to center, and we don't get a follow-through in price, after making such a big move, we don't get that follow-through in divergence, then what's most likely going to happen is you're going to get a pop. And that's what happened. We came right up, we were flat here, and then finally it made that pop up. Okay? So be prepared for that. If you go for a long period of time and we don't get price following through, then the divergence is dead. It's over with. Okay? Now, something I mentioned a moment ago is when the market squeezes down, something I want you to notice. See how all the lines here, they're all above, this is the 50, here's the 68, 63, the 50, the 37, the 32. See how they're all up here above the 50? get ready for the fall. 68, 63, 50, 37, 32. They're all down below the 50. Get ready for the move up. Okay? Look for those. Now, again, there's no guarantees in trading, but that's a high probable. When all of it squeezes down weighted high, or they're all way off on one side, most of the time what happens, especially your blue volatility bands, most of the time they are on both sides of the 50. But when your volatility bands, and this is something I noticed over and over and over, and something I look for when I trade, is when they all tighten down, or when all the lines tighten down, but also when both volatility bands are on one side of 50, the market's going to go back to center. Just like, I use the analogy of an old farmer in his pickup truck going down the Farm Market Highway or Farm Market Road in West Texas. That fly gets in the cab and he starts swatting at the fly, and he's not minding the road one bit. And he finds himself over in the ditch. The truck just drifts over into the ditch on the gravel, and he yanks back. Well, from time to time, that's what's going to happen, is the market is going to yank back to center. But just like that truck, just like that farmer in the old truck, he's going to yank back onto the road, and he's going to overshoot his lane, and he's going to come into the lane of the oncoming traffic, and he's got to yank back. The market will do that. When the market gets way to one side, it has a tendency to push back, and look what it does. It goes way up on the other side. And look right here. See the squeeze happening right there? Guess what's going to happen? A turn back to center. Okay? Until it stabilizes at center. Just what the market does. I've seen it over and over again. Okay? So be prepared, though, when you don't get the follow-through and divergence, let it go and be ready for your next setup. And here we come back down the middle, and the market finally sets up. We get a nice push up. But there's not really a clear indication here what's it going to do based upon Steve's market structure. Well, folks, I hope some of the information I've shared with you will help you out. Last but not least, one thing I want to share with you, I don't have it here in the slides, but jot this down. Get out your pen and paper and jot this down. Steve stressed that he looks at his 4-hour, he looks at his 1 hour, and once he's done with that, he really concentrates his efforts on the 15-minute. And he mentioned to folks in Orlando, there's no reason to go no reason to go hop, skip, jump around from chart to chart. Once you've studied your 4-hour, once you've studied your 1 hour, then concentrate your efforts on the 15-minute. Now, if the 15-minute, you're concentrating for an hour or 2 hours, then it'd probably be a good idea to go look at the 1 hour chart again, get a reassessment of the 1 hour, and go back down to your 15-minute. And the reason for that is all the information he's looking for has all been condensed, and he can just monitor the 15-minute. Well, folks started asking me in Orlando, well, Dean, do I need to go look at the 1 hour, the 4 hour, and then the 15-minute on the TDI? I'm like, no, you can really stay on that 15-minute chart, as Steve suggested, because let me share with you something. Jot this down. You've got the green line, the red line, the yellow line. On a 15-minute chart, the green line represents the current price movement on that 15-minute. The red line, again, the red line on a 15-minute chart represents the green line on the 1 hour chart. Let me repeat. The red line on a 15-minute chart represents the green line on the 1 hour. Now the yellow line on a 15-minute chart represents the green line on the 4-hour chart. Let me repeat. The yellow line on a 15-minute represents the green line on a 4-hour chart. So virtually, you don't have to hop, skip, and jump around and look from chart to chart to chart. You can see the green line's movement on the 15-minute, on the 1 hour, and on the 4 hour right there on your 15-minute chart. Your question here, have you all noticed correlation of the sharp pins on the 1 hour with subsequent action on the 15-minute as a signal what the market would do? I have noticed that I see a shark fin on the 1 hour. Then on the 15-minute, I might have the green line already break in the 50. Okay? Did you catch that, Mindy? If I have a shark fin on the 1 hour, on the 15-minute, I'm either going to have blood in the water already, or we're going to be crossing the 50 line. It just depends how much momentum and strength is on the is in the current market and affecting the green line. So, thanks everybody. Appreciate all the kind remarks. Has your trading changed any since taking Steve's class? Good question, Jeannie. I have a better understanding of the market structure and things to look for. I've always traded double tops and double bottoms. To some extent, I refer to the shark fins as the hook. I often refer to it as the TDI hook, and in my advanced synergy training, I would call it the TDI hook. The thing that I note now, having gone through Steve's training, is the market structure going on behind the scene to accommodate the hook or to accommodate the shark fin. Because there were times that I would see the hook or the fin, but the market would keep pushing up or keep pushing down. And it would give me another push, and I was like, I was upside down or I was in the opposite way of the trade. So at this point, now I see the market structure and I'm like, okay, you know, this may be a shark fin, a temporary one, because we might have come above the blue line, but maybe we're in level 1 now, okay, and not at the top of the move yet. So, Jeannie, that has affected my trading from that standpoint in a good way. Thanks, Adam. Appreciate it, buddy.